Hello and welcome to AI Market News by LM. The Japanese yen is just tumbling, hitting a multi-decade low. And it has traders everywhere asking one huge question. With the currency under so much pressure, what in the world happens next? So let's dive in and figure out what's really going on.
And here it is, the number that's causing all the fuss. As of US time, the dollar-yen exchange rate recently tagged 156.57. That number is a huge milestone, a really significant low for the yen, and it's definitely got the currency markets talking.
So that leads us to the big question, right? We've blown past 156, so is 160 the next logical stop? To even begin to answer that, we've got to break down what's driving this dramatic move and what else is happening in the wider global market. Okay, first things first, let's get to the heart of it. What exactly was the trigger that sent the yen on this downward spiral? Well, the trigger was actually super specific. Based on various news commentaries, reports started swirling that Japan's prime minister is pretty nervous about raising interest rates. And that feeling was backed up when two new anti-hike members were nominated to the Bank of Japan's board. For traders, this was a massive signal, loud and clear. Japan's central bank is probably going to stay dovish, keeping interest rates low to try and boost the economy. But none of this happens in a vacuum. The Bank of Japan's super cautious stance is in total contrast to what other major central banks are up to, and it's created this, it's like a tale of two completely different policies. And this really lays it all out. On one side, we have the Bank of Japan basically saying, whoa, slow down on rate hikes. On the other side, you've got the Reserve Bank of Australia, which just got some red-hot inflation data coming in at 3.8% year over year. That just fuels expectations that the RBA has to raise rates to cool things down. And this split in policy, it's a massive driver for the currency markets. It pushes the yen down while it pumps up currencies like the Aussie dollar where rates are expected to climb.
All right, so while all this drama is unfolding with currencies, there's a totally different movie playing out on Wall Street. It just goes to show how different parts of the market can be on completely different pages. Let's switch gears and head over to US stocks.
Yeah, this really sums it up, doesn't it? While the currency folks were glued to their screens watching the yen, US stock traders were all about a powerful rebound, especially in the tech world. And wow, look at the numbers from a recent session. It's just a sea of green. The S&P 500 up over 0.75%, the Dow right there with it, and the tech-heavy NASDAQ was the leader of the pack, climbing over 1%. All in all, a really strong day for the US markets. So what was fueling this? It really boils down to two main things. First, traders were jumping back into tech stocks after things had been a little shaky. And second, that whole move got a boost from some improving consumer confidence numbers, which always gives investors a reason to feel a little more optimistic about the economy. But to really get what's happening, we've got to look deeper than just the daily prices. We have to check out the currents flowing underneath the surface. So let's check out a couple of tools that help us read the room, so to speak. First up, there's the famous Fear and Greed Index. It's basically trying to answer one simple question. What emotion is driving the market right now? It mashes together 7 different indicators, everything from market momentum to volatility, to spit out a single score. And it tells us if investors are maybe getting a little too scared or, a little too greedy. Okay, another really important one is the CME FedWatch tool. This is where we get to see where the money is, literally. It looks at futures prices to figure out the odds of what traders are betting the US Federal Reserve is going to do next with interest rates. And when we use these tools to look at what bond traders are thinking, wow, a really interesting picture starts to form. They're starting to price in a longer than expected period of interest rate cuts from the Fed, maybe even stretching out into 2027. And a big reason for this long-term view? Growing concerns about AI. Here's the thinking. If AI starts to really disrupt the job market, that could slow down the economy, which would force the Fed to keep rates lower for longer to help out. Okay, so we've covered the yen slide, the rebound in the US markets, and the mood underneath it all. Now, what's next? What should we be keeping an eye on to see where all this goes? Well, for clues on what's next, we turn to the economic calendar. If we peek at the schedule over on investing.com, for example, we can see a bunch of key events coming up that could definitely shake things up. So, a few things on our radar. Germany's Consumer Climate Report will give us a feel for Europe's biggest economy. Over in the US, you bet, we'll be hanging on every word from Fed numbers, like the upcoming speech from Barkin, looking for any hint about rate policy. And then there are things like crude oil inventories, which can affect inflation, and bond auctions, which tell us about investor demand. Every single one of these is another piece of this giant puzzle. Which, brings us full circle, right back to where we started. With this huge split in policy, a tech market that's feeling good, and a calendar packed with potential news. Is this pressure on the yen going to keep pushing it towards 160? Or could something pop up and cause a complete reversal? I guess the big takeaway here is seeing how these global markets are so connected, and yet, sometimes, so disconnected. A quick policy signal out of Japan can send the yen reeling, while Wall Street is rallying on a totally different story. It's just a really dynamic and honestly a fascinating puzzle to watch. All right, just a quick reminder for us all. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. And remember, this video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.